banking is a critical tool for economically active individuals, businesses and other organizations. And while in South Africa this rings true, banking has changed a lot in just a few short years, with a shift from visiting the local bank branch to doing most of one's transactions online. And the bank's infrastructure has had to change to stay ahead of the curve and to keep up with demand in these evolving times. Major banks in the country have cut down their physical presence over the years while boosting their digital offering. So what does the future of banking look like? Is the bank branch set to die, or will the human touch always have a place in banking? Well, to share her thoughts on these and other burning issues, I'm joined by Bronwyn Williams. She's a futurist, economist and trends researcher. Thank you very much, Bronwyn, for joining us. So what trends have you observed in the banking space in terms of major banks' physical presence, i.e. bank footprint, and digital presence over, say, the last 10 years?
Well, absolutely. As you point out, banks are reducing their physical footprint, which is very expensive to maintain, particularly in our market, where, of course, our economy hasn't exactly been growing at a rapid rate over the last few years. But I think the other way to look at it is that we've also seen an increase in bank partnerships, particularly with retailers. As I'm sure many of your viewers and listeners will know, you can now do many more banking activities where you get your groceries in grocery stores and with other partners. So we're kind of seeing sharing of physical space as retailers also look to improve their profits through partnerships like this, in a way for banks to be able to reduce their physical presence but still service the customers who still need, as you say, that physical human touch. The other point that I can make, of course, in terms of the human touch is increasingly, yes, of course, having access to an actual human being in branch or even on the other side of the phone is becoming more and more of a luxury, especially as we see the rise of things like very, very smart artificial intelligence, which, again, I'm sure many of your viewers are becoming increasingly aware of.
Yes. So banking trends are also generational, aren't they? I mean, different generations want to engage with their banks differently, perhaps with older people preferring to go in branch than younger people. Is that a fair assumption to make?
Yes, in general, aside from older people who have accessibility and mobility issues anyway, if you are elderly and infirm, it's very, very difficult to go to a physical place, in which case those elderly people would appreciate the rise of more remote and more distributed banking, assuming, of course, they have access to those digital channels too. But in general, yes, younger people are much less interested in standing in a queue and going to a physical space to deal with their banker than older people are. And of course, brands and businesses are responding in kind. I think it's important to note that in the South African context, we have more under 35-year-olds than over 35-year-olds. We have a youth bulge. And that means that forward-looking, forward-thinking banks and businesses are going to be adapting their strategies and their service models to service the youth rather than service the elder side of the market.
Yeah. So how is South Africa doing? We always talk about this really important notion of inclusivity. How are we doing in terms of reaching out to those who've generally been marginalized, people in the rural areas, people on lower incomes? What's happening with them in terms of digital access?
Well, I think we can look at this in two different ways. Firstly, I think it's important to point out that digital access does allow more people to get serviced at a lower cost than having a physical service would cost to deliver to the market. So in that respect, our really forward-thinking and actually ahead of the global markets digitization of our banking services and our mobile banking services, which are still not actually available in all first world parts of the world, for example, can be seen as progressive at enhancing access to financial services. The other side of the point is, of course, you can't access digital financial services unless you have access to something like a smartphone. Again, there are more cell phones than humans in South Africa. This is a well-known statistic. So in theory, if we are able to overcome hurdles like expensive access to data and Wi-Fi availability, digitization of banking services can enhance digital inclusion. But then there's a third point I want to add into the mix there, and that is that we often tend to conflate the ideas of digital financial inclusion with access to things like debt. And I would certainly contend, if we are really looking to have a more inclusive, equal future going forward, we have to be investing not just in digital financial infrastructure, but actually in making sure we have a population that has finances and savings to save and income to invest to. So, of course, digital inclusion is about a lot more than having access to a bank account and a credit card. It is, of course, also having access to the economy that credit card and that bank account operate within. And I think there we've got a lot more work to do too.
Yeah. No, points well made there. So investing in digital infrastructure is no doubt a very costly business for the industry, but it's been clearly the way to go. Once banks offering sway more towards a digital offering and that infrastructure is bedded down and their physical presence decreases over time, are these banks likely to bring down their long-term costs and therefore be more profitable? I ask this question more as an investor than necessarily a consumer.
Yes, I think so. Of course, if you reduce costs, you have greater operating profits to work with and greater margins and all of those good things from a shareholder perspective. I think the other point that we can make in terms of future profitability, again, it might be slightly cynical to look this way, but of course, shareholders and banks being in the financial sector are going to look to maximize their shareholder returns and their profitability. We can also see that as digitization becomes the norm and as interacting with an AI chatbot, which can operate at scale at a very low cost to banks and businesses, become the norm, people, consumers, retail people that access banking services are going to have to get used to paying more for a human being on the other side of the line. In other words, services like financial advisors or like private bankers, or even just talking to an actual human banker who can override the chatbot normalcy is going to cost us more and more. So those services will become premium services rather than a base case service that previous generations would have expected from their banks. So this actually unlocks new revenue streams for banks as well as reducing their costs. Whether these sort of benefits are going to be passed on to consumers is, of course, up for debate. But given the sort of general competitiveness of our banking sector, which has seen a whole lot of new entrants, particularly in the digital space in recent years, I think that competitive pressure might actually translate into lower fees, at least if you are prepared to give up your human touch for a more automated, sort of a democratized, if you want to put it that way, experience.
Very interesting. One last question that I wanted to ask you. In these modern times, of course, the banks are moving more towards digitalization, but how do they differentiate themselves? And I say this because obviously they'll be offering the same old vanilla products. So with the sort of client centrism being so important for businesses to survive, you know, customers have to be at the center of their business. How can they distinguish themselves? How will they be able to do that, especially if they're moving away from that human touch?
Yes, of course, this is a challenge for all businesses, not just for banks, but certainly the trends we've seen in the banking sector and in South Africa in particular have been for banks to partner with partners. I already mentioned like partnering with the retail partners to have that physical footprint for the customers that still demand it, but also, of course, partnering with other sorts of partners in the goods and service market to build up things like loyalty programs. You'll notice loyalty programs are no longer the exception, they're now the norm. The way you attract and retain customers is to try and offer them something over and above business as usual. And a lot of that does come through in the form, as I said, of partnerships quite often with retailers who can bring that kind of brand cachet to otherwise a very vanilla kind of market, because it's quite hard to have an emotional attachment to a soulless bank. It's a lot easier to have an emotional attachment to some sort of retailer or brand that you already have a relationship with.
Yeah, Bronwyn, that was a fascinating discussion. Thank you so much. That was Bronwyn Williams. She's a futurist, an economist and trends researcher.